Hey guys, and welcome back to another edition of the Ginger Realtor Show. It's Mortgage Mondays, which means we must have Mike with us. Mike, thanks for stopping by again.
Love being here. Thanks for having me.
All right, Mike Longman is with the mortgage firm. For those of you who don't remember, we will try and get one of Mike's logos so we can start giving them the proper love. Mike, let's start off with what we've been talking about a lot the last couple of editions, and that's the Hometown Heroes pot. As of now, roughly, where does that pot stand?
2 days ago when I checked, it was 18.2 million. I would imagine it's probably down to 16, 17 right now. It's not moving as rapidly as the last round because, again, like I said, probably because of the holidays, or it's a little slower right now with the holidays. Everybody's doing their shopping, kids are coming home, so it's a great opportunity. I've been pushing it. I've got a couple of them going right now, and it not only is it not necessarily a fun loan, but it's just a good loan because you feel good about it. It's one of those things where you just feel good about that product. Like you're doing the right thing for the client. They're getting a great interest rate. You're getting help with their down payment. So, I mean, if you have anybody out there, whoever's watching and listening, it's a great product, and it's got so many open boundaries that other down payment assistance programs don't have. It's just a great product.
So I just wanted to clarify, because this is something that came to mind, and I'd meant to mention it previously, but it kind of like the last one had so much information I forgot. So let's talk about that young couple who are looking to buy their first time home, who've got 10% in the bank already. Now, can they apply for Hometown Heroes and get that in addition to what they're putting down?
Yes.
Or would you say, okay, put your 5% down, and then once the loan has gone through and you now own the home, to make that 10% as an equity payment against the principal?
Yeah, you could do it. The only thing you can't do with Hometown Heroes money is buy the rate down. That's the only thing they don't allow. Is they don't allow you to buy your interest rate down. They do give you a reduced interest rate. Like yesterday, Freddie Mac's Hometown Hero rate was 7% flat with no points. I mean, that's
not bad. I think I was looking this morning before we went online. I think it was 7.1 for FHA and VA.
Yeah.
I think 30-year fixed was a little bit higher, but
yeah. Now, if you do 30-year fixed, so it was 7.25 30-year fixed is probably what you saw. But if you do it Freddie Mac, which is a different scoring engine, and you're under 80% of the area median income, then you get an even lower rate. So it's 7% flat, which is just, I mean, that's a great. Yes, I understand we're coming off of rates a couple of years ago that were 2%, 2.5%, but eventually we're going to forget about that. I mean, eventually.
No, we are. I mean, and again, I think the natural place for rates to be in this day and age, and it makes me sound old, but it's between 4% and 6%.
Yeah, you are old, just so you know.
Sorry?
You are old. You are old.
I'm still in my 40s, dude. I mean, that's not old. I'm feeling attacked on a Monday morning. But yeah, I mean, I've been in real estate for what, 12 years now, and rates normally fluctuate somewhere around 4 or 5% mark, 5.5. For some reason, I'm dog sitting, so if you look in the bottom corner, the gray hand keeps popping in under the filter, so I apologize for that in advance. Just looks bizarre, but big lump. Okay, so we were saying 4 to 6% is where they've been on average. Yeah, you'll have your times where they drop below 4 and it's great, but I think we all know that rates were were abnormally low during COVID, just to keep the economy ticking over. Mm-hmm. Because if the mortgage industry and home buying stops, the American economy stops.
Absolutely. I mean, the historical average, I mean, if you go back the last 30 years, is probably in the 6s. I mean, we're going to be right back there. I mean, we're going to be right back there, and the home buying is going to explode. Hometown Heroes is helping that. That's one of the big helps. I hope they continue it after this $16 million is depleted. I hope they find money somewhere, and it really, like I said, it makes it fun. It really does.
Okay, so let's talk 2024. I mean, with the beginning of December, for those people who are looking in and thinking, you know what, I think 2024 is the year that I'm going to buy my house, what should they be doing now to prep for that home? And let's ignore the real estate side. Let's just purely talk from a financial health check perspective. What should I be doing if I want to buy a home in 2024?
Yeah, if you're looking Q1, Q2 in 2024, that you want to get out there and seriously start looking, first thing I would do is contact I mean, if you have a realtor, I know we're not talking real estate agents, but if you have a realtor that you plan on using, talk to them. They may know some local mortgage people. Obviously, you can call
All
me
right,
or
let's stop right there. If you're planning on buying a home in 2024 and you're watching this video, you
you're
would better
using
be
Gavin.
calling me. Like, forget other realtors. There are no other realtors. I am the one.
Okay,
Okay,
well,
let's go back.
I don't want to be so bold, you know, and say, then I'm the mortgage guy.
Yeah. Why do you think we do this? We're not doing it for just because we love the sound of our voices on the internet.
The
Guys, we want to work with you. We want to be your mortgage provider. We want to be your realtor. And we're providing you this information, not only to be able to get the information out to you, but to show our credibility that we are the subject matter experts. So 2024 purchase, first 6 months. You're calling me.
Get with
You.
Gavin gives you my information. I run. Let's look at your credit. We can do a softball on your credit, so it's not going to give you any kind of major hit. If you're concerned about your credit score going down, we'll do a softball. Let's find out where you stand, because you may not have had your credit run in 4 years, and you may think it's an 802, but you don't know. You don't know with this crazy world right now with everything that's going on. You could have. I've seen people that have 2 or 3 cars in their name that they don't know anything about. And those cars are all late payments because there's identity theft out there. So make sure that your credit score is up to snuff. You know, and obviously we can get you set up with a program now. But if you're looking in June, July, we don't know if that program's still going to be there, but we can give you ideas on what you can afford. What's like, if you're looking for a $300,000 house, this is a perfect example. If you're a first-time home buyer and you're like, $300,000 is where I want my payments to be, and you find a 3-bedroom, 1.5 bath ranch. Gavin finds you this beautiful little ranch. But then all of a sudden, your spouse decides, I want to buy a condo. I don't want to do the yard work. I don't want. And then all of a sudden, he's looking for $300,000 condos, but there's a $450 HOA fee on that condo. It might knock you out of the box that you're looking in, where your comfort zone. So just get with us. Get with us. We figure out what's comfortable for you. I tell you the ins and outs of condos versus townhouses and single family versus duplexes. And we find out what's comfortable for you. So we know when Gavin starts that search for you, he nails it down and he's not sending you 712 different properties to where you get
I am going to jump in. I'm just purely on personal experience. If my wife was looking for a condo, not wanting to do the yard work would not be her reason for that. Because in 12 years of marriage, and I love that woman dearly, I think she's probably done yard work half a dozen times. So between me and my son, that's where our yard work gets done. So I would appreciate that from her. Fortunately, now in Florida, we have a guy who does it for us. So yard work's definitely not a reason not to buy a single family home. And look, if you want a condo, I can't imagine why anybody would personally. But yeah, look, you've got to take a look at the HOA stuff. You've got to look at CDD and things like that as to how much it's going to cost to get in. But Mike's the guy to do that. He's going to be able to tell you, look, you're going to be pushing your financial limit on a monthly basis by doing it this way. Go buy the single family house. Besides, you have barbecues at a single family house that you might not be able to have at a condo.
And another real quick thing before I know you kicked me off of here. So another program just came out that's it's interesting. So it was always bridge loans were always a thing, and I don't know it in now because it just came out, but I pulled the guidelines last night and I haven't gone through them. I just kind of scrolled through them a little bit. So if you own a home and you owe $250,000 on that home, and that home is worth $500,000, okay, you can do a bridge loan now and pay off your mortgage on that home with the bridge loan, and then the remainder, $200,000, $250,000, can be used to be put down on the house that you want to buy. And they're not hitting you. They no longer count the bridge loan in your debt ratio with this one. Not every bank, but this one bank is saying, we'll let you borrow $500,000 from your primary residence right now that you're vacating and you're going to sell. It's not got to be on the market. Pay off your existing mortgage. And then that $500,000 bridge loan that they took, they're not hitting the borrower for that in their debt ratios. They're only hitting them for the residence that Gavin is selling them, which is huge. Now everybody's gonna say, well, what's the rate? Of course, there's always something. Nobody's gonna put their portfolio on a line like that without some kind of, but it's really not that bad. It's I think it was 7.75% on the bridge loan. And then obviously once you sell that house, you're paying it off anyway. I mean, it's really where it used to be. Bridge loans were so hard and they've become obsolete because you're hitting people for the bridge loan, you're hitting people for the new house that they're buying, and most people can't absorb that in their debt ratios.
Now, in that loan, is there an equity versus mortgage that you need to have? Like the one you said $500,000
You
loan,
can't have a
half of it
mortgage
in equity.
anymore. Whatever you do, whatever you pull out, the house you're pulling the equity out of, you have to pay off that mortgage. Like the best case scenario is somebody that says, "Hey, listen, Gavin, I want you to list my house on 123 Main Street. I don't know anything on it. It's been free and clear for 5, 6, 7 years, but I want to buy this house, but I don't want to. I don't have any money down, or I don't want to carry the taxes and the insurance and this." They allow you to pull that equity out to put it down on a new house to lower that, so you're not putting 3% down. You could put 50% down, and then they're not hitting you for
So
that.
I see how it's working. I understand the premise of it. I know how great a product it is from when I look at my buyers and who I have to sell as well.
It's very niche.
But everyone's situation is different, and sometimes if a house is not moving as quickly as you would like, and you've got a looming closing date for the purchase, then the bridge loan's the perfect product.
Yeah, it's 1 in 100 people, but it's something that's new. It shows you that the investors are starting to think outside the box. Even Fannie Mae, by raising that loan limit, they know it's going to be a busy year. It's going to be 2024 is going to be a busy year.
No, so everyone that I'm looking at from a I don't want to say influencer because it makes them sound really douchey, but the people that I trust and respect in the industry are fueling up for a year, maybe not quite as busy as pandemic years, but I think once that rate drops below 6%, we're going to see a huge rush to buy.
It's going to be a feeding frenzy.
It really is.
But the thing with that again is everybody that's not buying now because they're waiting for that. It's not going to be all unicorns and rainbows or whatever they say. When that time comes, it's going to be a feeding frenzy, and that $300,000 house, be prepared to pay $360 for it. Yeah. So I mean, there's a lot of beauty in that.
I think that waiting to buy until the rates drop is such a misnomer in the industry. And the problem we've got is there are so many voices out there who have their own financial futures tied into rates staying high versus inventory staying low. They're betting against the market and with the market. It's like you really can't trust a lot of the voices out there because you don't know what their motives are. So when you hear people saying it's a terrible time to buy right now, it's not. Yeah, no, competition is low. Sellers are providing dispensation towards rate buy downs, towards cost, towards closing. There are not a lot of buyers out there right now. So as I say, with lack of competition and an aggressive agent who can negotiate for you, it's a brilliant time to buy right now. Look, I hate the marry the rate, marry the mortgage date, the rate type of thing. But really, it is a situation now where if you can get into a house now for $400,000, and you might have a 7% interest rate. 6 months down the line, that house is going to cost you $450,000. And your interest rate might drop a point or two, but what's it really going to save you? And if the interest rates drop and stay low, refinance. Like the amount of money you'll spend on the refinancing costs versus what it will be long term between the increased house prices and things like that, it's crazy.
Like, I tell people you can always refinance it. You can always refinance it. You can't go back in time and buy that house again because somebody else is living in it.
Yeah, I mean, the CEO of Alignment did an example of the wait and see type of mentality. And okay, yeah, look, I'll say the monthly payments you have right now, if you bought a house in the last 5 years, your rates are definitely going to be lower than it is right now. But if you look at the difference in the price of what your mortgage is right now versus what you would be paying at a slightly inflated rate, versus the house cost now to what it will be when those rates come down, you're quids in to buy now. Yeah. I think the study he did was a 4% interest rate versus a 7% interest rate on a $500,000 house. And that $500,000 house appreciates over the next 12 months to be $550,000, at least. Because as I said, we're expecting a feeding frenzy in 2024. So that $550,000 could be $575,000. Now, you wait, you have to spend $75,000 extra 8 months down the line. That extra expense you would have spent on your mortgage rate is getting eaten up and swallowed by the money you have to spend extra in the mortgage. I'd rather have an extra $50,000 in equity and be paying a bit more than have to pay a bit more and have a lower rate.
And one other thing that people aren't talking about, a lot of people are talking about what you and I just mentioned. One other thing that people keep missing, and so when the feeding frenzy starts and that $550,000 or that $500,000 house is now $575,000, and now it underappraises because the appraisal market and opinion hasn't caught up with the market. Guess who's got to pay that difference? The buyer. So now you need your money down, you need your appraisal gap money, plus you're paying $575,000 for the house with what, a 1% less interest rate? Trust me, the numbers won't work out in their favor.
I think maybe on the next one, maybe we'll put a whiteboard up and we'll show those numbers exactly how they would look.
Sure.
Between now and then, we'll work on a scenario, and then we'll put it up so people can see just what that difference would be. Because I think they'd be
appraisal gap's a killer.
Yeah, the appraisal gaps, the interest rate difference, the equity, and I think what most people don't look at is okay, I'm going to spend $500,000 in a home in 8 months' time. Well, let's be honest, that $500,000 home probably was only $440,000 when you were looking at it today.
Yeah, and if you wait a year and a half, guess what you're doing while you're waiting? You're paying rent.
Yeah, it's look.
I can go on all day.
It is. It's that age-old essence, that the story that we're always telling. Look, you're always paying a mortgage. It's just not always yours.
There's only one good thing about waiting right now. There's only one person that it's good for, and that's the landlord.
Yeah.
Because you're paying their mortgage.
Unless you live with mom and dad. If you're living with mom and dad, not so bad. But if you're about to buy a house and you're still living with mom and dad, you should have left home a while ago, even if you're just renting.
Yeah.
I guess somebody who left home at 18, like the idea of being with my mom and dad in my 20s. No. I couldn't.
Are you a pool player? You're a pool player?
Yeah.
All right. I'll keep that in mind.
Okay. Well, listen, Mike, I'd love to bomb over and play pool all day with you, but it's Monday, so we got work to do. Thank you very much for stopping by. Guys, look, if you want to get in touch with me, I will refer you to Mike. Mike, just so we know, what's your phone number so people can reach out to you directly?
It is area code 973.
New Jersey.
New Jersey guy, but I'm in Florida. 973-600-8864.
And we'll have that up on the screen for him. That way you can give him a call. Mike, do you have an online application app that people can kind of start the process with?
Yeah, it's
Don't worry about it now. We'll get it open. We'll have it linked so people can get in there.
All right, sounds good.
We're gonna go and do some Monday stuff. I believe I got a lot of phone calls to make today. So guys, we will see you in 2 weeks with Mike. We'll be back again soon. Thanks for stopping by.
Everybody have a good week. Thank you.